You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
Hey, what's up, Shoe and Show listeners? So glad that you're back and joining us here on the world's only footwear business podcast. I'm your host, Matt Priest. So grateful to have you with us. Today, it's just me and a buddy of mine, two NC State grads, two Wolfpackers, getting together and nerding out on shoe pricing and costing information, otherwise known as inflation, or maybe it's deflation, or somewhere in the middle. I'm the layman. He's the scholar, or the economist, I should say, and that would be one Gary Reins, FDRA's chief economist. Gary, welcome back to Shoe and Show, my friend. It's always good to have you on the program.
Hey, thanks, Matt. I appreciate it. It's always good to be back.
All right. So let's get right to it. The inflation numbers, the CPI numbers, they came out last week. So we got a view into what's happening on the inflation side and what is like the top two or three headlines as it relates to what the numbers indicated last week.
Yeah, it was, my opinion, was much ado about nothing. The previous month, everyone got excited because inflation came in just a wee smidge higher than everyone's expecting. And of course, suddenly the sky is falling. Stagflation, rumors abounded. This month, it was just the opposite. The numbers came in just a wee smidge lower than everyone expected. And the markets took off. Everyone took it as a good sign. Big scheme of things, it was maybe 0.1% bounce one way or the other. And I think it was largely much ado about nothing. Specific to footwear prices continued to increase, albeit at a decelerating rate. It had come down. The increase had come down a bit from what we'd seen in March to what we saw in April. Modestly, I think maybe 1.4% year over year.
It is modest. Is that a rounding error in economic speak?
More or less is. The previous month was 1.5% increase, and that was the fastest in 16 months. But even so, 1.5 is still paltry.
Yeah, so you said much ado about nothing. It's Shakespearean. One of the things that we look at is these numbers drop, everyone kind of reacts. In fact, as we're speaking right now, the Dow's hit 40,000 today, which is a huge number, obviously. It's historic. And so investors, we've talked about this for a long time, but we're in this weird zone where like bad news is good news and good news is bad news. Are we still in that, or are we in an era where we're kind of moving out of that direction and we're going to start looking at traditional KPIs in the traditional way?
Yeah, really, I have to agree. I think we're largely still in that environment of, what's bad is good and good is bad, up is down, down is up, cat sleeping with the dogs, all kinds of anarchy and chaos. But with the inflation number in this latest month, as I said, it was still up 3.4%, modestly slower than the increase witnessed in March, 3.5%, but still a long way from the Fed's 2% target. And as I have maintained for months, it will be, the long right tail I keep referring to. It'll be a long time before we see, I think, inflation moderate and stay at that 2% threshold that the Fed has maintained.
Is that an artificial threshold in the sense that we need to recast the paradigm in our minds and it does, maybe something north of 2%? Look, we're not talking 8% or 13% like in the late 70s, early 80s, but maybe something of like the 3%, 3-ish, if you will. Is this kind of an artificial barrier because the jobs numbers are still good? Mm-hmm. I think there's a couple pockets of softening on the consumer side. We can get to that in a minute. But for all intents and purposes, what if we're in an era where inflation is just ticking up modestly between 2.5%, 3.5% swing? Is that a terrible place to be?
I think it is. I mean, you think about it, the difference between a 2% increase and a 3% increase is a 50%, faster rate of growth in that 3% increase. So the Fed, while that 2% is a bit line in the sand, if you will, I don't want to say it's a artificial number. It's not kind of a wet finger in the wind guesstimate. It's a target that the Fed has maintained for decades, really. And Chairman Powell a couple of weeks ago said, no, it was not 2.000. We don't have to get below this magic threshold of 2%, but it's got to be a whole lot lower than what it was, and really what it is. And really this 3.5% range, inflation has been at that for a little over a year now. to come down rapidly from the upwards of 9% we'd witnessed here about 2 years ago or so, but it's still at 3.5% is still a long way from that 2% target, and I think it'll be quite a bit longer before we get back to that level.
So, as a total aside, if a wet finger in your ear is a wet willy, what's a wet finger in the wind? What is that? You don't have to answer that.
That's right.
If we're moving past wet fingers, is your expectation still? And we're going to do a deeper dive into the footwear prices here in just a second, but is your expectation still that the Fed is just going to kind of hang tight for the rest of the year, unless there's some kind of dramatic thing that happens that pushes them in one direction or another?
Yes. In fact, on the Tuesday calls, we have maintained for some time that the market was expecting several more rate cuts this year, and the Fed has maintained in the Federal Reserve's Federal Open Market Committee, that the rate setting committee within the Fed has maintained no, we're likely to stand pat, while not coming out in such explicit terms. That's essentially what they've implied. And indeed, we've seen that the market's expectations have gone from, 5.5 rate cuts expected earlier this year to maybe one rate cut expected now. And I think these latest numbers from the Fed show that inflation moderately slowing, but there's still a lot more room to go. And I think it really confirms that the Fed is going to stand pat for the next couple rate setting meetings, the next couple months. Maybe we might see a cut, if not September, I think on closer to the December meeting.
All right, so let's do a deeper dive into the footwear specific prices. We always break it up by category: women's, children's, men's. So if I'm reading this right, we've seen women's footwear prices tick up, children's is up just a smidgen, men's is offsetting some of that. How do you kind of, when you see these numbers, whether this month or any month, Gary, how do you kind of unpack the differences between what's driving men's prices versus women's versus kids? Is there a way for the layperson who might be new to the industry to think about this in a way that's more, I think, strategic?
Sure. In fact, you're exactly right. We've seen increases the last couple months in men's and women's, and I think the last 2 months, year-over-year declines in children's footwear prices. Specifically, men's has seen the biggest increases, year-over-year increases for the last 3 months. Key drivers that we keep a pretty close eye on for gauging what's going on or likely to be going on with retail footwear prices are landed costs at the port, and particularly the duties applied, duties paid on those landed costs coming in. And we've shown pretty good analysis in the past that that's an indicator of what's likely to happen with retail footwear prices.
Yeah. So in fact, I want to correct the record because I kind of misarticulated that. Footwear prices in men's were up 4%. Women's rose 1.1%. Children's were down just south of 2% at 1.9%. So those variables are interesting. The men's footwear pricing is interesting. Is there any seasonality to this year after year? If we were to look back, let's say in March, April, spring of 23 or 22 or 21 and so on and so forth, that we would see similar trend lines on the costing front? Or is it just entirely driven by 10 trillion different variables of the materials used and demand and inventory positions and the currency and blah, blah, blah?
Yeah, great question. In fact, the Bureau of Labor Statistics, the folks that produce the Consumer Price Index, including prices for footwear, produces prices in both a seasonally adjusted and a non-seasonally adjusted basis. Of course, when we're looking at a year-over-year percent change, it effectively rules out any seasonal effects because you're comparing, the same month a year ago. So let's say, Christmas, perhaps there's a Christmas spike or a Christmas, decline. Well, if you're comparing, December to December, that's going to negate that impact. So on a year-over-year percent change basis, while these are non-seasonally adjusted numbers, I don't think there's really any time you can go back and go, aha, clearly you see, this year-over-year increase spike every month here or trough every month, this year. I don't think that's the case. In not adjusting for this year-over-year percent change basis, essentially not doing this first difference like that, you can see a modest seasonal trends in the data, but because we're doing that year-over-year percent change basis, it essentially negates it here.
So let's unpack the men's side of things a little bit more. Margins are obviously critically important in any consumer good. They're historically and extremely tight. across a lot of different categories within footwear, not all of them, but a lot of them. And so when you look at the men's pricing, so we saw a 4.4% increase in men's footwear prices, and that puts men's year to date at 2.5% versus the same 4 months of 2023. So just so everyone's kind of level set on what we're talking about. But then you articulate that at the same time, the average landed cost of men's year to date footwear imports is off 8.6%.
Mm-hmm.
That sounds like a margin opportunity to me. I'm no economist, if you will. That's why we have you on our team. But talk to us about the margin opportunity there.
Yeah, I think that's exactly, you hit the nail on the head. As I said earlier, over the long term, looking at annual data, there's a pretty strong code movement, a pretty strong correlation, how we see trends in the average landed cost and how we see these trends in retail prices. Looking specifically at men's, that strong correlation is evident until this year. And like you said, this year we're seeing that men's prices year to date are up, about 2.5%. While the average landed cost for men's footwear imports are down a little more than 8%. And that's really a pretty wide divergence, unlike anything we've seen in about 30 years worth of annual data. So I think that gap is not likely to persist. But while it does persist, I think that does create a margin opportunity there. Essentially, we're seeing higher selling prices and lower import costs. And I think it presents that margin opportunity for retailers.
All right, well, let me be cynical, Steve, for a second. Let's talk about just the way the data comes in. And so if I'm thinking, okay, year to date at the border, footwear prices are up, or year to date at retail, footwear prices are up 2.5%, but at the border year to date, imports are off almost 9%. Based on kind of the flow of goods, and when do the products at the border in that 9% assessment become a part of the 2.5% assessment on the sales side, on the pricing side, if that makes sense? It's probably really difficult to figure that out with any specificity. But how should we think about this, the movement of those goods across border to retail, and when should we line those things up so that we know that the price of the shoe or the import off at the border is actually what's driving margin opportunity? If any of these questions make sense, but I think you see what I'm trying to get.
Yeah, absolutely. In fact, as I said a moment ago, this long-term code movement is looking at annual data. I've done the same with monthly data, and of course, the relationship is not as strong, even with any accounting for any number of leads or lags between those import costs and those retail prices. Not as strong on a month-to-month basis, I think, because there's so much noise bouncing around month to month. But on the year-to-year basis, it's a much stronger code movement between these average retail prices and these average landings for these imported goods. So again, we've got 3 months data in 2024 for import costs, and we've got 4 months, the first 4 months of data for these retail selling prices. So certainly there's a lot more room to go in 2024, but gosh, we're already a third or a fourth of the way through the year. So it's a pretty strong tendency of what we're likely to see shake out for the full year.
Let's play that out. Let's do our best. Let's pull out our inner Bill and Ted and get into the phone booth with Rufus and head. Some of these are going to go way over people. Our millennial listeners have no idea what we're talking about, but you and I, we're tracking. We know exactly what I'm talking about. So we get in the phone booth at the Circle K. We head to December 31st, 2024. Let's talk imports, pricing, costs. What is your prediction? We got, quarter's worth or almost or more than a quarter's worth of data on a lot of those key performance indicators. Where are we going to be looking as it relates to the industry when we get to December 31st, 2024?
As I said a bit ago, this is an unusual divergence that we're seeing in year-to-date data this year, really unlike any annual divergence we've seen in nearly 30 years worth of annual data. I don't know that this divergence will persist for the full year, and it's certainly something we'll be keeping a close eye on to see if there's kind of this narrowing. Essentially, by the narrowing, I mean that these average landed costs tend to rise, or these average retail prices for footwear tend to decline year over year. That may be the case as that divergence narrows. I'm not so sure really that that'll happen. Two key reasons. Number one, as we talked about earlier, inflation. If inflation persists, well above this 2% target and anywhere close to this 3.5% range now, it suggests that footwear prices may continue to see persistent year-over-year increases. There's a pretty strong relationship between retail footwear prices and the inflation rate over the short term, the last couple of years or so. So if we see inflation stay relatively elevated, higher than the Fed would see these persistent year-over-year increases. All right, number two, average landed cost. If the dollar remains relatively strong, as it has the last a couple of years or so, that suggests that the average landed cost for footwear, not specifically just men's, but just footwear in general, is likely to remain relatively depressed. And if that's the case, there's not much evidence to suggest that those retail footwear prices are set to decline, or that those average landed costs are set to increase, suggesting that that divergence may persist much deeper into this year. While I think it will narrow, I don't think it'll come close through the balance of the year.
If you have the divergence and the consumer starts to soften, consumer confidence goes down, consumer starts to hold back on purchasing, that seems to give retailers in particular a little bit more leeway to provide some promotional opportunities on products and still hold on to some of that margin, which is so precious. So I guess what I'm getting at, the layman's approach to this is, hey, if that's the case and there's that divergence still out there, then and the consumer's starting to soften, then it's not going to be as painful for me to lower prices, to bring more shoppers in, to sell more units, to move more product, to move through more inventory than it would otherwise if maybe that divergence wasn't existing right now.
Yeah, I think so. Looking at the relationship between softness in the economy, particularly softness in consumer spending, and retail footwear prices gets a bit murky. It's not a very clear relationship between the two. But to your point, if there is that margin now available that maybe hadn't been there as much as in the past, yes, I think if the consumer spending specifically on footwear does tend to soften, then that implies there may be a little bit more room than in the past for margins to maybe cut to have that room to be able to entice more shoppers into the store.
All right, as we close out, let's just do a little bit some shameless plugs, because we are constantly putting out data in the Intel Center for FDRA members, and you're the wizard behind that. If you peek behind the FDRA curtain, there'd be a little dog named Toto, and then there would also be Gary back there pulling the levers and playing the organ and the smoke machine.
Sure.
So talk quickly about kind of what, as it relates to the data we just talked about, what do we bank in the Intel Center, and why is that critically important to members to have access to that?
Oh my goodness, we really try to look across the whole footwear supply chain, everything from what's going on the manufacturing side to imports coming into the U.S. to what's going on at retail. We've got a number of different metrics to kind of gauge how much the shopper is spending and what the consumer is spending on, to what's going on with prices for those goods. And of course, within all that, kind of stepping back to look at the macro side, what's going on in the broader economy, what's happening with the dollar, and how does that ultimately translate to footwear demand and footwear prices. So we really try to look at the whole enchilada, even footwear companies' revenues and inventories, to kind of get a gauge for what's likely to be going on. Looking at that inventory to revenues ratio is a pretty good, pretty strongly correlated with prices as well. So again, looking at the whole onion, we're always trying to peel back the next layer of the onion to see what's underneath. So I'd certainly encourage folks to have a look there. And if you have any questions or frankly suggestions of maybe issues that I'm not looking at, by all means, let me know. And as I say, I spend my day looking at pixels on a screen. So sometimes the whole can't see the forest for the trees thing. So, hey, say, Gary, have you ever thought about looking at this issue here? And it might be one of those, V8 moments. So by all means, I encourage folks to do that and take a look at the Intel Center. And if you have any questions, comments, or snide remarks, by all means, let me know.
That's hilarious. So we got onions, we got enchiladas, we got trees, and we got V8. So to that point, I was texting with a friend who used to be in the industry, who was a senior executive in the industry for a long, long time. And he and I were in a hotel lounge 11, 12 years ago. I can't remember exactly. And we started to formulate this report that would be a commodities report, a footwear costing report. And of course, we were the two Bobs from Office Space. Like, we came up with this idea. Of course, we can't execute against it. So who do we call? We call Gary Rains. We say, Gary, can you pull together this report? It still sits in the Intel Center to this day. It's one of our most valuable reports, I should say. And it's just a testament to feedback we get from the industry, and then how we pivot and create a product that it benefits all of our members, not just those who came up with the idea.
Yeah, I really take pride in that commodity report, looking at a number of different commodities used in footwear manufacturing and distribution, and trying to put method to the madness to not only show why prices or those wholesale costs are doing what they are, but maybe a bit of a peek around the corner at what's likely to be happening next quarter or next year and why. As they say in economics, right or wrong, but never mistaken.
Well, with that, we're going to end our conversation here. Gary, thanks so much as always, not only for your insights on this during this conversation, but your continued support of the industry. We value extremely. I know the industry does as well. And we really appreciate you coming on to talk more inflation. That's kind of what we all talk about these days. So thanks for coming on.
Great. You appreciate it. Anytime.
All right, folks, it's another amazing edition of the Shoe and Show. We thank you for listening. We ask that you go and rate us. We have this cool algorithm that only allows for 5 stars, so don't even attempt to give anything less than that. The system will kick it out. But make sure, all kidding aside, you're sharing these episodes, you're rating them, you're pushing them out, or you're subscribing to them wherever you get your podcast. We'll be back next week, next Monday morning, with another great edition. We're approaching Market Week in New York, so we have some really good content coming out relative to Market Week, and we hope that you check that out. And until next time, Shoe and Show is out.
Shoe In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.